Good afternoon. We are about 5 minutes behind the schedule, but I'm sure that we'll be able to finish everything in time for other activities you may be planning for this afternoon. The title of this session, breakout session, is I have so many sessions in Korean and English. Financial Regulation Reform at the G20 Process and Safety Net. That is the title. And I have distributed before a few questions that we like to discuss at this panel, but let me give you a few introductory remarks. As you all know, that one of the lessons we learned from the 2008 financial crisis, the U.S. subcrisis, is that laxity in financial regulations, in fact, almost the absence of financial regulations in some segments of the financial system, contributed to boom bust the cycle in U.S. housing market, and which in subsequently led to the collapse of the U.S. financial system as well as the financial system throughout the world. So the G20 leaders agreed to discuss and come up with solutions to reform of financial regulations at regional and the global level. So far, they have concentrated on three areas. One is the capital adequacy for internationally active financial institutions. The second one, which is still working on, systematically significant institutions, reform of systematically the significant institution. In short, too big to fail institutions. How should they be regulated at the global level? Because they have a significant and important systemic risk implications. And the third one, third type of reform focuses on the reforming the creation and distribution of many structured derivative the products. And as you can see that at the request of the G20, the Financial Stability Board has come up with a Basel III new capital adequacy requirement. But then there are many people who are not happy about the Basel III, the capital adequacy requirement. For instance, it will take something like almost 10 years for these banks to comply with the Basel III capital adequacy requirement. And so the people are asking, why do we have to wait for so long? Why do we have to give banks time to make adjustments? There are some questions on the time profile of the Basel III requirement. And another problem is that the Basel III reform has very little to do with the emerging market economies. In fact, most of the banks in Korea, even in Korea, they can satisfy, in my view, that's what I heard, and I could be wrong, then please correct me, are able to meet that Basel III requirement. And it's just totally, to many people, it's totally irrelevant. And I don't think that is the case, but nevertheless, there is this perception. And then, the too big to fail too big to fail bank reform and derivative product regulations, they're all somewhat unrelated to the kinds of the regulatory issues and problems emerging market economies have to deal with after the 2008 crisis. So I would like to ask panel members, what are these reforms that are being discussed, that has been proposed and that has been discussed at the G20 for that matter, at the different international fora. What are in your view, which types of reform are most important, and especially in particular from the perspective of the emerging economies, they are relevant. And this is the question I would like to ask. And also, once you take up this issue, then you will be able to respond to the other issues, other questions that I proposed for you to discuss. I don't know how much time I should give each and every participant, but about how much time? 10 minutes? How much time is it? 16 minutes per person?
16 minutes for all the sessions.
Okay, so if I give about 10 minutes for each, then I think that will be quite enough. So that about 10 minutes, and then I have two lists here, and the first person I would like to call on is Michael Helbeck, the Korea Standard Charter financial what do you call it? Huh? Bank, financial bank. Okay. So you have about 10 minutes. Yeah.
Thank you, Professor Park, and it's an honor to be here. I'm probably the only one who doesn't have an academic background here, so I'm a practitioner, having worked in the banking industry for the last 27 years, of which 14 years here in Korea. Coming on your comments, Professor Park, in terms of what is relevant to emerging markets and what is not relevant to emerging markets in terms of the financial reform undertaken by the G20, I think maybe just take one step back and review on what has been accomplished so far in terms of the Basel III Accord on capital and liquidity. My reflection on that is, A, that it has been done in a record time, and unifying different opinions from different markets. I think there's a record achievement. The reason why there is a 10-year-long compliance period is obviously for banks to adjust to it. However, many people may think that is a very long period or unduly long period of time. The reality is that most global banks already today have been beefing up their capital levels, their liquidity levels, because we're all under pressure from analysts and stockholders and from the public that is scrutinizing our financial status. So even though we have a long period to comply with Basel III standards, most of the international banks have already made very serious and profound preparations to meet those future standards and are over-complying with currently required minimum capital standards. And I think Dr. Lee can probably attest to that from his perspective as a former regulator. So I think already those limitations are having some kind of foreshadowing effect in terms of already complying now with future required standards. Then maybe another comment in terms of the other G20 financial reforms. I think a lot of progress has already been achieved but I would call this a quiet revolution, because you don't really find much being written about that in newspapers, because obviously good news don't sell very well. But I think there has been a lot of achievements in deleveraging of global bank balance sheets, and I bet with you won't read about that in any newspaper. But if you look at UK banks, for instance, I mean, there's been a massive deleveraging of bank balance sheets that has happened very quietly. Nobody noticed it. There's also been massive recapitalization of banks. There has been a complete revamp in risk management behavior. And we were debating this over breakfast this morning, Dr. Lee and I, in terms of, how all these measures are relevant in preventing another financial crisis. And I think there's only so much you can do in terms of regulatory architecture, in terms of regulatory requirements. But what has to change, obviously, is behavior of banks. And second, what is maybe left out in this discussion is that we also need to look at the importance and relevance of fiscal policies and monetary policies. And I take the view that we are seeing today already emerging signs of concerns over the massive amount of liquidity coming out of the quantitative easing programs in the US and monetary easy policies in Europe that are flooding the other markets, particularly the emerging markets, with a huge amount of liquidity. And this is where it now becomes relevant to emerging markets, becomes relevant to markets like Korea, who I would not classify Korea as an emerging market. I would say Korea is a very highly developed market. But countries like Korea are definitely having issues with how to handle the massive inflow of capital that is coming out of quantitative easing in the US. So the relevance for countries like Korea is then how to deal with this from a macroprudential point of view. And I agree for Korea, Basel III is maybe less relevant because all Korean banks are Basel III ready today. So I think the relevance for Korea is more in terms of how to address the negative spillover effect that arises from monetary and fiscal easy policies in other so-called developed countries. And if I just reflect on the Korean experience, where Korea has tried over the last 9 months to take macroprudential measures, such as on the demand side and the supply side of liquidity, foreign liquidity coming into the country by, for instance, reinstating a withholding tax on foreign bondholders, non-resident bondholders, by putting in limitations on foreign exchange derivatives volumes that banks can trade in relation to their capital, and by implementing a bank levy on foreign currency liabilities of onshore banks, all of which is designed to try to contract a little bit the amount of foreign capital that is coming into the country, particularly the short-term capital, the so-called hot money. I think it's the right approach. Hot money is a problem for economies of the size of Korea. It's also a problem even for countries like Australia and for several other countries like Brazil. So it is a common shared problem amongst the emerging market world that needs to be dealt with. Now, in terms of other relevance, I think what is relevant to all markets is certainly the handling of the derivatives market, the further tightening of the derivatives market, as well as the establishment of central counterparty exchanges for trading of derivatives, as well as governance aspects that the G20 has undertaken, including the review of significant, systemically important financial institutions. And on that note, I would like to also comment that on this whole too big to fail debate, I think we should reflect on whether or not the size of banks was really a cause for problems during this last crisis. I would like to take the view that the size doesn't really matter, because we saw large banks failing, we saw small banks failing. Northern Rock, for instance, is a small specialized mortgage lending institution. Was probably not even known before it failed. Bear Stearns was a large bank, but it was again, it has a high risk concentration on mortgage securities trading and so on. Whereas other large banks like J.P. Morgan, for instance, didn't have a problem at all. On the contrary, for them, the crisis was an opportunity to actually acquire additional institutions and get bigger and stronger. So I would contend that size in itself is not the cause of the problem. And therefore, I don't think it would be the right focus to look at the size of banks. I think it's more about risk management practices within the bank and behavior of bank, and that requires more scrutiny in terms of supervision. So I think to sum it up, I think relevance to emerging markets may be a little less in terms of implementation of Basel III, because most emerging market banks, certainly in Asia, are already Basel III ready, and for the Asian banks, capital was not really the problem. What was the big problem for emerging market banks was the sudden outflow of foreign currency liquidity. I mean, that was really the problem that we have been grappling with. And for Korea in particular, having had that painful experience 2 times in the last 14 years of having a sudden and very massive outflow of foreign capital, has certainly left a shock on policymakers in Korea. And I think that is the current challenge that Korean policymakers are trying to address. I'll stop here and give an opportunity to other speakers here to.
Thank you very much. If any one of you wants to discuss this, the big fish, small pond problem, that is the high degree of volatility of capital inflows and the sudden reversal, you are welcome to do so. And what kind of capital control or prudential regulations, or for that matter, the types of capital control that may be efficient and maybe desirable for a country like Korea.
Yeah, Mr. Chairman,
Okay,
I'll take up the.
I will ask I will give you the chance to talk about it, but let me follow up on this schedule. I mean, I have 2 different schedules. I have this here, Mr. Yoshino from Japan, and second.
Okay.
This discussant is Mr. Yoshino.
Okay, thank you very much. I prepared PowerPoint, but I would like to talk without my PowerPoints.
Why?
Okay, can I use it?
Here,
Okay.
no?
Can I use my? Okay, thank you very much.
Okay, good.
Yeah. If you look at this chart, this is bank lending divided by GDP, and thick line in the case of USA, thick line in the case of Japan, and dotted line is the case of Japan. USA. In both cases, credit will expand very fast in the bubble period. So I think that the monitoring of the bank credit, especially housing loans or real property loans, are very important in case of the bubble. So we often talk about the capital requirement based on each risks, but we also look at the bank loans, behavior of bank loans. So that is one point I would like to say. And secondly, in all of bubbles, first initial point is the easy monetary policy or quantitative easing. Because when the economy is faced with recession, central banks start to take into easy monetary policy, and that causes excess liquidity. Then it is very happy share prices started to rise. And wealth effect will have a very good impact on consumption and expansion of sales. And number 4, that is the improvement of business conditions, and investment will increase. So the economy looks very good, consumption, investment going up. And number 7, everybody seems very happy. Then the central bank is very difficult to stop in those conditions, and it always delays to tighten the money market and monetary policy, and that causes the bubble. So I think based on these macro indicators, we have to look at banking behavior very carefully, especially the growth rate of loans to real estate in comparison to total loans. And secondly, the growth rate of real estate loans exceeds much, much further than real economic growth rate, then that is something wrong. So that is first point. Then I would like to talk about Basel capital requirement. In Basel, many of these requirements comes from micro-oriented basis. So what kind of risks each loan has, and so on. And they accumulate those risks, and they define the minimum amount of capital requirement. But I used a different approach, the macro-based approach to regulate the capital requirement. Because almost all those risks are based on macro factors, like asset prices, or interest rate, or business conditions. Then if I take asset price, GDP, and interest rate, and so on, then you can find each country should have different minimum capital requirement based on those macro variables. Furthermore, when the economy is in boom, then these minimum capital requirement has to be raised. For example, in number 2, case of USA, when the economy was in boom, it should have been increased 4.42%. And the Japanese case, after the recession, it should have been lowered minus 2.20%. So this, from this figure, the Basel requirement should not be identical to all over the world, but it should be based on country by country, and macro factors has to also be taken into account. So that is one point I would like to discuss. And second one is too big to fail. I think in many industries, not in financial industries, we are talking about competition policy. If in financial market we have a competition policy, then very large financial institutions will not exist because we need much more competition among various financial institutions. So one is why do we make so much large and monopolistic financial institution? Then one of the ways is to make them a little bit more smaller scale and create competition. And that is one. And secondly, post-crisis impact by central bank or financial services agencies are very important. Crisis prevention is also important, but how to deal with when we are facing with some crisis. And capital injection is one of the ways, but we have to disclose how much money has been spent to each financial institutions. Then, if the financial institution recover, that those money should be returned to the government. That is the experience of Japan. And of course, Japan took so long, but we have disclosed how much money has been spent to each financial institutions, and that became very transparent to many general public. Then the last point is, do these reforms will apply to Asia or emerging economy? I think Asia is slightly different from Western countries. First, this figure shows many of the Asian countries are bank-dominated economy. So if capital requirement becomes very high, then they are very much reluctant to make loans to risky borrowers and small and medium-sized enterprises or venture businesses, which the market is very different from Western countries. Western countries have capital market, bond market, which can allow SMEs and venture businesses can raise their money. But Asia is dominated by banking industries. So we have to think about how should we provide riskier money to those SMEs and venture businesses. And one of the ways which we started in Japan is we should create regional funds or regional bond market or regional funds or regional mutual funds market, which is not the bank loans, but they can collect money from investors and then sell it through bank branches and then provide those money to riskier borrowers, including SMEs and venture businesses. So Asia is different from Anglo-Saxon, and when we take into account of those financial market, our solution should be different. So those are.
Thank you. Thank you very much. Perhaps you'd like to spend less on your presentation and more among discussion among yourselves. I mean, different people seem to have different ideas and proposals, and so it might be more interesting to have interaction among the participants. So please, the third person, the William Overholt, would you? He's a senior fellow at Harvard University Kennedy School. Okay.
Thank you very much. It's an honor to be here at this wonderful conference. Almost every aspect of what the G20 has done is controversial. There's one thing that's not controversial, and that's that Korea set the gold standard for managing G20 meetings. The French have been complaining about how difficult it is to meet the Korean standard. I think the most important thing about the G20 is simply its existence, the acknowledgement that the world has changed. It would be nice if we could get that acknowledgement into the leadership of the IMF sooner rather than later, although it doesn't look as if that's going to happen. I think the bank regulatory reforms are very good, very much in the right direction, very incomplete, and do not address the main issue of avoiding another bubble. The capital and liquidity requirements we can fiddle with. There are great difficulties in having standards based on different calculations for each country and each region, but those the strengthening of those requirements is absolutely essential, and that's a major accomplishment. The shared understanding of what kind of bailouts were needed in the crisis, I think, is also extremely helpful, particularly because it's very controversial in each country. It's very helpful in the United States for leaders to be able to point out that there's something of a consensus around the world and of a need for to avoid systemic collapse by conducting certain bailouts. On the management of derivatives, having the clearinghouses and funneling more of the derivatives through clearinghouses is useful, but the essential thing is we need much greater transparency in the markets for over-the-counter derivatives. Having worked for what was the leading derivatives bank of the world, I can tell you that any definition of a standard derivative that needs to be cleared through a clearinghouse can easily be evaded, and the size of the books that can be built up overnight is enormous. So there we haven't gone far enough. The effort to address legislatively the problem of bankers' pay, I think, is a major error. Certainly the focus on incentive systems as one of the core problems is correct. But what the current approach is doing is just driving everybody to Hong Kong, which is not going to legislate on this issue. Analysis of appropriate incentive systems needs to be part of every stock brokerage report, every credit report, every corporate governance report on every institution. And the way to get it taken seriously is just to get it incorporated into that process whereby the market sets standards. And that's the only way you can do it, because anything you can legislate, the banks can game. We used to reset the bonus system every single year because there isn't any incentive system that can't be gamed. The old story in Russia, if you gave bonuses to a company by the pounds of nails it produced, you got one big nail that weighed a lot. And if you incentivize them by the number of nails they produce, you got enormous numbers of tiny nails. What you have to have is a continuous scrutiny by bond raters, by brokers, by corporate governance experts that can move their thinking as fast as banks can change their systems. all the systems will fail and cause problems unless we make progress on accounting, on common accounting standards. Under current different accounting standards, the capital adequacy ratios can be gamed, the liquidity issues can be gamed, and so we've made a good start on these things, and the framework produced by the G20 says very clearly that we have to accomplish this, but that is very difficult, and the other things don't work without that. I would disagree with my colleague, Mr. Helbeck, about size not mattering. The impact of failure on the system is proportionate to size. If you had if every bank were small, then any bank could fail without any difficulties. But when Citibank is much more likely to fail because it's so big and unmanageable, and the effect on the system of its failure is enormous because it's so big. And in no other line of business would you be allowed to fail every 15 or 20 years and not be dismantled. And what happens, the way things work today, is that when these huge banks fail, they're bailed out, and then they buy up all the other little banks that they have caused to fail, and they become even bigger. And that's not the way the system should work. I'm not saying we should dismantle all big banks, but if a huge bank fails repeatedly, it should be dismantled. And if it can take the system down all by itself or with a couple of its colleagues, then it does need special scrutiny. I would also call attention to we haven't solved one other problem, which is the range of institutions that needs to be regulated. We have a capital adequacy standard for banks. Where do hedge funds fall? Where do private equity funds fall? Where do all sorts of other financial institutions fall? Again, we can take this as not a failure of what's been achieved, but it shows that we're at the beginning, we're not at the end. And we haven't done the job until we get to the end. On bank regulation, the final thing I have to say is that there's a problem that I don't think any of us know how to address, and that's what the Japanese call structural corruption. There is so much money in these institutions that, particularly in Japan and now in the United States under the new laws that take the controls off corporate funding of political campaigns, the ability of the system, the political system, to sustain a rigorous bank regulatory system over time is a potentially insuperable problem. I can tell you that every single year we got several notices at my bank from the chairman's office that he hoped we would contribute generously to the fund that supported politicians who were voting to allow retail banking and institutional banking to be done by the same thing. And every year you're going to see erosion. We need to address that problem conceptually. Finally, I'm going to make my biggest point. Biggest point. All the regulation of individual banks is of no consequence if we don't deal with the issue of global liquidity. At a time, anyone who has gone up and down in the Hong Kong market or the Singapore market knows that if if you have incredible liquidity in the market, it doesn't matter how well you regulate the banks. You're going to have huge bubbles, and it's going to bring down a wide range of businesses, a wide range of individuals, and there's going to be an economic crisis. Again, it doesn't matter how well you regulate the banks. These great bubbles, these great crises are caused by governments. And today you have zero interest rates in the United States, zero interest rates in Japan, negative real interest rates in China, and negligible interest rates in Europe. If that continues, we're going to have another terrible crisis. And the mutual assessment process gets us started talking about that, but we need to make actual progress on it, and that means getting the U.S. and China to do very large-scale important things to rein in global liquidity, or we're going to have another great crisis, and all the other work of the G20 is wasted. Thank you.
Thank you. In deference to our foreign participants, I asked them to speak first, but now we have two Korean participants, and I'm going to ask Chang Young Lee to summarize and to respond to all these questions at the end, okay? So that Dr. Hong is going to be 1, 2, 3, a fourth speaker, and Chang Young Lee, you were former. Still, you are the. You left. Right time, you left right time, and so that you could pick up pieces here and there and then respond to make it a little more interesting. So, Dr. Hong, again, you can say whatever you want. This is a free island.
Thank you very much, Mr. Chairman. I was going to talk about the massive capital inflows and outflows Korea faced during the last financial crisis, and also talk about the new measures introduced by the Korean government to cope with those volatility of the capital movement. But Mr. Halbeck already took up the issue, and he talked what I plan to talk. So I'll just show.
Please, you could repeat the same thing, because this is the most important issue right now, confronting Korea.
So
so
first,
that
I'll show you the.
Right, please. This is.
I'm not sure
important
you can you can see this one without breaking your neck.
Then I'll move.
The capital inflows to Korea. We had the two financial crises, foreign exchange crisis during the last 15 years. The first one, of course, the Asian financial crisis in 1997. The other one is the one, the year 2008, the global financial crisis. There is you see there are histograms. I'm talking the second one is about the capital outflow of during the East Asian financial crisis, and the fourth one is the capital outflow during the last financial crisis. And you can see the amount of the capital outflow after the 2008 financial crisis for this about the $70 billion for just 3 months after the crisis. Then it came back, as you see. The last one shows The Korean government introduced several measures to cope with this kind of cope with the volatility of foreign capital inflows and outflows. The first one is the government introduced ceilings on the forward market, the foreign exchange derivative positions of the bank as a ratio to their capital in June year 2010. Of course, the objective was to reduce the short-term external debt that resulted from the bank's provision of forward contract to corporations, therefore preventing the possibility of a sudden massive withdrawal of capital, especially by the foreign bank branches. Secondly, in January 2011, the government reintroduced withholding tax on the foreign purchase of treasury and monetary stabilization bonds. So the foreign corporations and the non-residents are also subject to the withholding tax, which was previously only applicable to resident purchases of bond. That one was already mentioned by Mr. Herbeck. Then thirdly, from August, the third measure will be effective on August 1st of year 2011. The one is that the government will impose a macro prudential stability levy on banks' non-deposit of foreign exchange liabilities. The amount of levy depends on the length of the duration of the bank's borrowings. These measures, especially the ceilings on the forward market foreign exchange positions seems to work. You can see from the diagram after the last financial crisis, the foreign capital returns. Out of the three forms of the foreign capital inflows, the bank short-term borrowings is about the 14 billion, which during the crisis, the outflow was about 50 billion US dollars. So the ceilings on the foreign forward market exchange rate position seems to work. Yeah, that's one. Thank you.
Oh, okay. Thank you. It's very interesting the discussion on something which I didn't know. Now, Chang Young Lee, he held a very senior position at the financial supervisory services, and you could present your own preparations, or you could respond to some of these questions raised by other participants. You have free hand.
Okay, thank you, Mr. Chairman.
Leave some time so that you could have interaction among yourselves.
Sure. Thank you for inviting me to this important seminar. I myself have been participating in the Budget Committee meeting and actively involved in the actual debate and the discussions since the start of the crisis and then until the final standard were agreed December last year. So I witnessed all these, tensions and, pros and cons of each proposals. And to give you a brief, sketch of that meeting, the U.S. and the U.K. were at the forefront of the reform proposal. Obviously, they have stronger momentum for reform. And on the other side of the camp, a group of countries like Germany, France, and Japan, opposing to these reforms. And surprisingly, China is on the side of this proponent, US and UK, and Korea was sitting in between. But because Korea was G20 chairman country, we tried to transcend national interest and try to mediate between these two groups. But finally, we came up with this landmark reform called Basel III. But let me make one point about this, assessment of this Basel III reform to prevent a future crisis. If properly and consistently implemented globally, I think Basel III will significantly reduce the probability and severity of the next crisis. But as you know, the 2008 financial crisis in US was not primarily the result of the lax regulation, but the abuse of the US financial system by the political community in Washington, forgive me in saying this, and also monetary policy mistake by US Federal Reserve. For example, US government so-called affordable housing initiative, it's a welfare state initiative, allowed the bank or even forced the bank to lend very highly risky mortgage loans. And then two government-sponsored enterprises, Fannie Mae and Freddie Mac, also guaranteed these loans and restructured these loans into mortgage-backed securities. And these two government-sponsored institutions are still exempt from this Dodd-Frank financial reform bill. So they are still going very strong, continue to make loans and guarantee loans. And the Federal Reserve, as you know, contribute to this credit bubble that caused housing prices to soar. It's classic asset inflations. So what I want to say is the no amount of regulation can compensate for poor economic policies. But Basel III is a good starting point. I think it can reduce the probability of next crisis significantly. It has many unique features. Professor Young-Chul Park only mentioned capital adequacy ratio contained in the Basel III. But in the Basel III, there are 4 key priorities. One is raising the quantity and quality of the capital, including very strict definition of the capital. And the focus is now on common equity, so-called the core Tier 1 ratio. And this core Tier 1 ratio, bank will be required to triple from present 2% to 7% by 2019. Of course, some criticism that, at the final stage of the negotiations, the certain aspect of this definition of capital and also the long implementation timetable and overall ratio had been somewhat watered down to win over Germany, France, and Japan. But this is a good starting point because in addition to this strengthening of the capital adequacy ratio, there are 3 other important elements in the Basel III. I think next important one is the introduction of new global liquidity standard called liquidity coverage ratio and net stable funding ratio to deal with short-term and long-term liquidity mismatches. I think this will require banks to withstand more severe shocks than they had been able to in the past. And thirdly, introduction of the leverage ratio as a backstop to the risk-based capital framework. I think this leverage ratio will provide additional safety net in case so-called risk-based capital framework like Basel II or Basel III understate the true risk faced by the bank. And lastly, a significant increase in risk coverage and stricter capital requirement for counterparty credit risk and securitization activities, which was a key mechanism through which the financial crisis was propagated. Having said that, one last thing, and this is more unique feature of the Basel III, its introduction of a macroprudential element into the capital regulation. I think Professor Yoshino has made a good point on this one. I think capital regulation should reflect the macro aspect of the financial system. And here, the Basel Committee agreed to introduce so-called counter-cyclical capital buffer. And the banks should build up this counter-cyclical capital buffer during the boom cycle for use in downturn cycle, as well as capital conservation buffer of up to 2.5% of risk-weighted asset. This is to prevent inappropriate distribution of capital through dividend payment or generous bonus payment. And another thing is loss provisioning standard that has been changed too, from current incurred loss basis into more expected loss basis. In other words, more forward-looking provisions. And this will allow a bank to set aside more provisions during the boom cycle. And these reforms, I think, will significantly reduce the probability of the future crisis. And according to the recent Basel Committee analysis, the macroeconomic benefit of a stronger regulatory capital and liquidity requirement would be 1.4% of GDP higher in terms of the lower probability of crisis and also the smaller losses in economic output. Yeah. And then costs arising from this more constrained bank lending would be only 0.2% of the GDP. So the benefits to the society will greatly exceed the cost to the individual institutions. And Mr. Helbeck's point, going back to Mr. Helbeck's point on the size of the bank, I agree that size alone does not matter, but the complexity of the institution, global activities of institution, interconnectedness of the institution, and substitutability of the institution is more important. That's why in the ongoing talks about CFI regulation, how to strengthen regulation for systemically important financial institutions, and by mid this year, they will come up with about 20 to 30 global CFIs based on these 5 criteria of systemic importances. And then authorities are considering ways to strengthen capital treatment for this CP. I mean capital surcharge for CPs and also liquidity surcharge for CPs and more stronger supervision for the CPs. And Korean FSS has already implemented this stronger supervision for local CFIs. I don't think Korean banks will be selected as global CFIs. And the frequency of bank examination has been changed from 2-year cycle to 1-year cycle now. And Professor Overholt's point, I think that the global liquidity situation is more important, and he seems to be very much concerned about future crisis originating possibly from this global liquidity situation. I couldn't agree with him more. And that's why at the Seoul G20 summit meeting, we have decided to discuss in Paris next G20 meeting the emerging market perspective on the reform proposal. And one of the elements would be how to deal with these global economic imbalances like fiscal deficit or trade deficits. And also in that in that emerging market perspective, another element is how to deal with this foreign exchange risk, as mentioned by Mr. Michael Helbeck. The relevance of capital controls. I think it's not direct form of control, but more indirect form of capital or tax-based capital controls to deal with this sudden reversal in capital flows. And that kind of issues are put up to the Paris G20 summit meetings. And Professor Hong also talked about the danger of sudden reversal of capital flows. And then Korea's, we, in spite of all this liquidity ratio requirement we imposed on local bank and also local bank, the foreign bank branches in Korea were exempt from this foreign exchange liquidity ratio requirement. So we have now finally decided to impose some kind of prudential controls on these foreign bank branches in terms of so-called this macro-prudential levy and other liquidity ratio. And relevance of all these Basel reforms to the emerging market countries, I think from emerging market perspective, one thing that concerns me is whether this leverage ratio requirement will lead to a significant reduction in the supply of trade financings to the emerging market. Because the letter of LC or letter of credit, LC or other contingent credit exposures are now counted in when calculating the denominator of the leverage ratio, which is total exposures. So I think the bank in trying to reduce excess leverage, they may reduce the supply of trade financing in form of LC. But I think big banks will change from now on their business model, and a lot of trading companies will also likely choose more often form of direct trade financing before full implementation of 2018. Anyway, like
All right.
the...
All right.
Okay.
No, I mean, just keep 1 more minute, okay?
Okay.
Yeah.
Anyway, like liquidity ratio framework, the Basel Committee has a process in place to assess the impact of liquidity ratio and impact of leverage ratio on business models of individual countries. And if necessary, they will make some adjustment. For example, credit conversion factor will be adjusted downward when translate from off-balance sheet item into balance sheet items. So LC, I think, problem will probably go away. And then Korea and other emerging market countries face the problem of this huge short-term liquidity shortfall because they are lacking of so-called high-quality liquid asset like a government bond because of very conservative fiscal policy in the past. Korea's LCR ratio is estimated to be only 76%. We have to achieve 100% by the year 2018. This means about some 60, 70 trillion won worth of short-term liquidity shortfall. I think this kind of problem is same true for China and also Australia, other emerging market countries. But as I said, BCBS has another opportunity to review this process. So all the emerging market countries should make sure that these new rules will not, hamper their economic performances. Thank you.
Thank you. As you can see, after listening to 5 eminent participants, the comments on the regulatory reform, I'm sure that many of you are somewhat confused and couldn't understand what would be the most desirable regulatory reform at the regional, country, and the global level. And in fact, I have attended last several months conferences on the global regulatory reform. And in many conferences, I heard totally different the stories. And so I'm going to summarize some of these issues that came up in our discussion, and so that you could exchange among yourselves. One, global liquidity. Well, somebody told me that nobody knows what global liquidity is. There is no global definition of global liquidity. The best one, which is derided by many people, is the M3. That is M3 plus reserve used by the IMF. And so many people don't worry about the global liquidity, especially if you speak to the Nobel Prize winner, Paul Krugman. He couldn't care less about global liquidity. And then the second, Basel III. Well, I really like the Chang Young Lee's presentation because I have heard that similar presentation many, many times for the last 2 years. But then, well, the banks are given for the next 10 years to implement Basel III. And many people, industry people, think that by then, Basel III will have to be revised by Basel IV or Basel V. You know that there are many countries which have now accepted Basel II. You know, there are quite a few people, not people, but countries, which have completely ignored the Basel II. So the question is, how are you going to enforce the implementation of Basel III, not only in the advanced countries, but also developing economies? And then the third, the question that raised about Basel III was that, well, if they're given these restrictive requirements, some of these banks will move their business out of the banking and into something else. In other words, there will be many ways of avoiding these regulations, but then they could be wrong, and then you could discuss. And then the size matters. Well, nowadays, many people argue that what we need is a large number of smaller banks rather than big banks, failure of which always create systemic risk. But then, given this, the structure of banking, the banks are subject to scale economies. And so that once you have this scale economy, you simply will not be able to prevent the rise of the banks. And then incentive system. Well, depending upon how you analyze and how you assess incentive system, every bank and every financial institution institutes some kind of incentive system, but then it has not stopped. It has not resolved this moral hazard and adverse selection problem. In other words, that incentive system can be a good complement to regulations, prudential or otherwise, but it's not going to be the most important one. And then from the Korea's point of view, for instance, the capital control. Does Korea need capital control to stabilize the capital movements in and out of the countries? And if they do, the IMF, the proposal on the capital control and the instruments they proposed, are they adequate? And again, that is a question that has to be discussed in the future. And finally, we talk about macroprudential policy as if we know what it is. Again, it is very difficult to define macroprudential policy. It has two elements. It's a horizontal element and a cross-border element, and when you combine them, always it's very difficult to find out what they are and how different they are from macroprudential instrument, that is different from monetary policy the instruments. And then there is this interesting point Yoshino-san made. In a banking-oriented system, what you should do to support the risky investment by small and large firms, small and medium-sized firms, and for which he's proposed this regional fund or regional bond market, and that seems to be very interesting. So these are some of the questions, some of the issues that I picked up, but there must be some other things. Okay, the accounting transparency. And on this, I hope the Europeans and Americans would come to agree on which accounting system they are going to adopt. So now, who will be speaking? We have about 10 more minutes so that you will be able to say whatever you want. Well, 3 minutes. You can have 3 minutes. Dr. Hong has 3 minutes.
Actually, the organizing committee gave me the yellow card, which means that we have only 3 minutes.
No,
and it was 5 minutes ago, so we are only 2 minutes past.
No. I was given the 10 more minutes, so that we'll finish 20 after 3, and then 10 minutes for coffee break, and then you move to another session. Okay? Yeah.
Yeah.
So very brief. I don't know what the 3 was. I mean.
Just very brief comment. I think where we have unanimous agreement amongst all of us here at the panel is concerns about the impact of global liquidity, even if you mentioned that it's hard to measure it, but it's definitely, you can see it everywhere. So the low interest rate environment and the monetary easing that we see in many markets, I think we're all violent agreement that is the biggest current cause of concern. And I would also like to emphasize that, no matter what regulation we put into place, no matter what supervision system we enforce, that problem needs to be dealt with, or else we're going to see bubbles bursting in several markets.
Yeah, but what do you mean? You see something which you don't know what it is. I mean, how can you say that there is excessive liquidity if we cannot define what it is?
Can I
yes,
mention about what we define global liquidity? We usually take first bank lending, which I have shown. One of them is that trend of the bank loans divided by GDP is one of the ways, or the trend of monetary growth in comparison to its up and upside down. And I think global liquidity can be defined by each country. And currently, the excess liquidity is also creating commodity price, increases the commodity price. It is facing to oil and natural commodities. And then what should we do about monetary policy for each country? Each country sometimes look at the Taylor rule. And if the country is in recession, they try to lower its interest rate and increase its money supply. So that is a domestic monetary policy. But that will also affect to the international capital flows. So I think, liquidity, the definition of liquidity can be possible by looking at the trend, and then it's a deviation from the trend. Yeah.
So you talk to the IMF and the BIS people, all right? Anything else that anyone else wants to make a comment on this, or any other issues? For instance, incentive scheme, it doesn't work. Doesn't work. That's what many people say. Hasn't prevented this moral hazard problem.
No fixed system will prevent a moral hazard problem. If you have some combination of phased bonuses over a number of years and clawbacks, and you keep revising it as people figure out how to game the system, you can make a difference. Bonus systems make a huge impact on the performance of bankers, but no legislated system will ever be effective for more than a year.
Okay. All right, Mr. Helbeck, I stopped you while you were speaking, so you have 1 more minute.
Thank you.
And then I will.
I just wanted to maybe respond to some of the comments. So when I said that size of the banks doesn't matter, I should have added that I fully agree that large and significant institutions definitely, given their complexity and the interconnectivity aspects, definitely need a different level of supervision, and certainly should be held to a higher standard and to a more scrutiny than smaller institutions. I think the point I was trying to make is that the evidence from this crisis does not suggest that larger banks would fail more easily than smaller banks, because we've seen small and big banks failing. But I would heavily agree that complex and significantly important institutions require definitely much more supervision than others. So I think we're in violent agreement on that. I think one aspect that we haven't talked about, because that discussion sort of hasn't come across to our part of the world here in Asia, is the whole discussion around Glass-Steagall, and I would be interesting to hear your views in terms of is that really relevant to fix the effect of the crisis? Because clearly the crisis does not give any evidence that investment banks were failing more easily than commercial banks, because we saw commercial banks failing, we saw investment banks failing. So why is there, what evidence would suggest that by separating commercial banking and investment banking activities that would prevent another crisis? I don't know whether you have a quick comment on that.
Yeah, I wouldn't argue that reimposing Glass-Steagall would prevent another crisis. The only thing that will prevent another crisis is getting the liquidity problem under control.
All right. Dr. Hong.
Yeah. Mr. Chairman,
2 minutes.
you talk about the possibility of instead of instituting the new capital control measures, the use of the fund from the regional financial arrangements such as the Chiang Mai Initiative and the IMF's PSCOFCL. But the main reasons for countries to wait until the funding to the IMF is unavoidable is, I think, can be summarized in 3 items. The one is the stigma, this reflects the negative connotations attached to the IMF itself, as well as the perception that the conditionality remains heavy-handed and intrusive. And the second one is a wrong signal. Countries may fear that turning to the IMF for crisis prevention would be interpreted by the market as signaling more severe problems than recognized. Thirdly, alternatives to fund financing. Several emerging countries with the dollar liquidity shortage were able to get a short-term currency swap lines with the U.S. Fed. In addition, countries also favored the financing with a few strings attached fund from other development institutions. Yeah.
Okay. Thank you. Thank you very much. And for those audience, I would like to thank you for your patience. And if you are confused and if you do not understand what we were talking about, you are not alone. And no matter which conference you go on, regulatory conference, you will feel the same way. So don't blame us. We have done extremely well trying to summarize and try to get to the point. Yes, sir. Yes.
Professor Overall, one of the crises is looming. How soon it comes? Because of the global liquidity.
If I can answer that, I will keep very quiet and become a billionaire.
Listen, you better share some of your billions with us, huh? Okay. Thank you very much. Thank you very much.